Okay, good afternoon, folks. 2 o'clock has come around, and we're all very delighted to bring you our latest version of Where Will the Money Be Made? Talking about numbers to the end of June 2024 and how we see the next 12 months for the investment landscape. Today, we've got quite a few of our in-house experts sharing their expertise with you, and we're going to take you on a navigation through the markets. I'm going to start off talking about global equities. But first of all, just quickly run through the overall views. I think if we break the world up into 4 major categories, from a domestic equity perspective, we're fairly constructive. We've had a nice bounce in markets with elections that were better than people expected. There's some nice tailwinds for the local market, and we maintain our overweight position. I think over the course of the last 5 to 7 years, it's been very seldom that we've been more bullish on local than global equities, but for the second quarter in a row, that's the stance. From a global equity perspective, I think we've been largely correct in remaining bullish over the course of the last 9 months or so. It's been a good year for global equities, albeit weighted towards a few big macro tech companies. But we are pulling down our global equity view to neutral with a projected 7% return. And that's largely on the back of valuations. The prospects for the economy and US earnings growth looks pretty good. But when things look good, it doesn't come cheap. And when things look good, it doesn't come cheap. And if the economy does falter in any way, there's certainly some potential for correction. So we think over the course of the next quarter, there is a chance of a correction. We would remain in equities over time. This isn't a call to reduce our equity exposure, but we're pulling that down to neutral. From a domestic fixed income perspective, there's pretty nice returns available. And from a global fixed income perspective, cash still remains interesting at a 45% yield. And our high yield fund is showing yields of over 5.25%. So if we do that in tabular format, we can see from a domestic equity perspective, we're looking at returns of 14% over the course of the next year, and Liam's going to take us through that. And as I've been saying quite a lot over the course of the last few months, there hasn't really been an easier time in the life of Anchor Capital to get inflation-beating returns for clients. Global bonds are generating 12%, our Anchor Core Income funds generating 9.3% against an inflation rate of around 5%. And internationally, you can earn 5.3% in a JP Morgan money market fund with inflation now running at about 3%. However, as soon as one wants to get more than that, you have to take a bit more risk. We then have to factor in the risk and return and make those asset allocation calls. Listed property, we're still expecting a decent return after some quite nice returns over the course of the last 6 months. But we pulled that down to negative just on a comparative basis. And that's because equity and bonds probably higher returns with a little less risk. From a global perspective, the message with a 7% 12-month return is kind of a neutral one. So we would stay invested. But certainly with what markets have done over the course of the last little while, with new money, we would invest it fairly cautiously. Global bonds staying at roughly the same yields and coming out with a 5% yield. Corporate credit, 6%. And then, of course, something that we've been working very hard on and creating for clients is alternative product solutions. And that's something that is the global trend with higher yields and some interesting investment opportunities available. We think we can get 10 to 5% domestically and 8 to 12% globally with much less volatility than equities. And we'll talk a little bit more through that. This is really the chart that informs what's happening in the world out there. The US Fed funds rate effectively sets the price of money around the world. And you can see after close to zero rates for 15 years, we're now at almost the highest rates in 20 years. And the questions in investment markets is how quickly that comes down. So the US 10-year government bond yield is now sitting at about 4.3%. And as rates come down and as inflation cools, there's a prospect of that coming down, although we're not predicting a massive reduction in rates over the course of the next little while. So this is the equity market story. I think it's always nice to put things in context. Back in October last year, the market was starting to falter. People thought that US growth could come off quite sharply. But ever since then, over the course of the last 9 months, the US equity market's up 30%, led by the big tech companies. And we've almost gone from a phase of growth could slow to nothing can go wrong. So we are a little bit concerned about the complacency setting into markets. I think if you look at all the big global investment banks and you look backwards 12 months ago, almost all of them were predicting a recession in the US by now, and almost the exact opposite has happened. Although we do have to look under the lid, and as we'll show you in this presentation, a lot of that return, and especially this year, has come from the big tech companies. So there are some opportunities in the other 494 companies in the S&P 500, although nothing really comes that cheaply at the moment. So we're sitting at a phase when you're in a bull market and the market's been doing quite nicely for some time. We typically, the call is how much further does it run? And one thing I've learned in my career is it often runs a little bit faster than you expect, which is why a quarter ago, when things were looking expensive, we maintained our bullish view. However, 1 quarter further out and a further nice return for the last quarter, one certainly has to look at the bull and bear case for equities. So the people who are saying you should stay invested, talking about the strong US economy, 13 to 14% earnings growth from the S&P over the next 12 months, declining rates. It's obviously much nicer to be invested when rates are at 5.25%, because the Fed's got the potential and bullets in the gun, to pull some triggers if things do start to slow. So if rates and inflation has started to come off, and if rates come off for the right reasons, normalization reasons, more than trying to prop up the economy, the stock market could still give a decent return. Europe and Japan look cheap, and earnings upgrades coming through there. So that's the kind of good news story and the reason to keep a portion of your investments in equities. As we're kind of an equity-centric house, and we'll always suggest having an equity portfolio as a portion of your portfolio. So what's the bear case then? If the economy does slow faster than expected, the penalty for being wrong is quite big. At a forward 21 PE multiple, the market's at a 25% premium to the mean, in the top decile. And if you do see some slowing, you could well have a correction. It wouldn't be unusual after the rise that we've had for the market to have a 10% odd correction. And that's why we're expressing a little bit of conservatism. The geopolitical risks are certainly very high, and the risk of sticky inflation. And in fact, the whole Trump story coming through, and we expect to discuss a little bit more of that in the question and answer session. Trump coming through, he's likely to pull down taxes. He could inflate the economy further, and the Fed might pull back on interest rate reductions, and they might come a little bit slower than expected. So those are the kind of two scenarios for the bulls and the bears. From a risk return perspective, we're saying at the moment we'd probably hold back a little bit with new equity investment and wait for some better entry points. I think the stage that one always has to look at from an equity perspective is global growth. And you can see that's looking pretty solid into 24 and 25. And this is really the key thing that drives global equity markets. This is the earnings growth in the S&P 500. And a nice, close to double-digit earnings growth in 24, a strong year in 25, and continued in 26. So a company that you're buying that's making $100 at the moment will be making over $130 on average in 3 years' time. So, the companies will tend to be more valuable, and it's really a question of what's priced in at the moment. The valuation tables, which are the PE multiples on the top left-hand side, is the S&P, which you can see is sitting at around 21. It got as high as 22. Just because valuations are high, it doesn't mean you can't get returns. The two drivers of equity markets, very simply, are the earnings growth and the multiple that's placed in it. And we've shown you that there's pretty strong earnings growth coming through. The MSCI World on the right-hand side, likewise, shows a similar pattern, although America is more accentuated because of the big tech companies. But if you look at the earnings growth numbers in the orangish color at the bottom, you can see nice double-digit earnings growth predicted from companies around the world for the next 2 years. That's on the back of reducing interest rates, muted energy prices year on year, and general economic growth coming through. So if you look through, what's happened in 2024, if you look at developed market equities, the one that I've circled there on the left-hand side, a 12% return coming through from developed markets, but largely led by large cap US tech. And another way to look at that is the contributions in the MSCI world. And on the right-hand side, in the first half of 2024, there's been a 12% total return year to date from equity markets, but 3% of that has come from NVIDIA, which is quite remarkable. So 25% of global equity returns have come from one share, and another 3% has come from the rest of the Magnificent Seven, which are the big tech companies. So half of the return coming out of 7 shares, and the other 6% coming out of the other 494 shares, if you look at it from an S&P perspective. So very few active asset managers would have been bold enough to have 35% in the top 7 shares. And, to be overweight would have been a big call. So passives have tended to outperform over the course of the first half. But of course, if these shares don't perform as well as the rest of the market, that can reverse quite quickly, which is why we favor a diversified and balanced approach. The NVIDIA story, NVIDIA is now the second biggest company in the world. It's a $3 trillion market cap company. And this is, what provides some comfort with it is the extent to which the earnings price has been driven by underlying, the share price has been driven by underlying earnings. Here you can see the NVIDIA revenues, which was sitting, the quarterly revenues at just over $5 billion in March 2023. So just over a year later, that revenue's gone up to $25 billion or $100 billion annualized revenue. So all the CapEx spend in tech companies, or a huge portion of it, has been shifted, especially the big 5 companies, has been shifted into AI chip spend, creating capacity to run large learning machines. And, it's been a massive change. And this compares with the laptop, the PC, the introduction of the internet, a fundamental change in where money is spent. However, one does have to be a little bit cautious with NVIDIA. 20% of its expenditure is from Microsoft, which has shifted a massive amount of its CapEx over into the spend. And about 60% of the revenue comes from the top 5 companies in the world. So, it's difficult to see the same sort of growth being sustained. And post 2020, this NVIDIA's still got a lot of growth in it, as you can see. But as you look out a year forward, it actually makes the world seem like quite a small place, because it's the big companies spending the vast proportion of their R&D and CapEx spend in this space. So you're now paying on the right-hand side about a 40 times forward multiple for NVIDIA. But the company is making super profits. It's marking up its products 5 times, making a 65% operating margin. And there's a huge amount of money being put in by competitors to catch up when that kind of money will be made. That's certainly not sustainable in the longer term, but it's a company that's landed up in the right place at the right time, with significant processing capacity in its chips, because it had specialized in the gaming world. And it's been an absolutely phenomenal growth story. The emerging market world, if you remember that the MSCI world did about 12%, emerging markets year to date up about 7.6%, with China, the Hong Kong listed Chinese shares doing fairly well, and South Africa doing reasonably. But again, for many years in a row, developed markets have been a much better place to be than emerging markets. From an underlying economic perspective, this is the last payroll numbers coming through very strongly. And this is the thing we're probably watching most of all. People only employ people when they're optimistic about the future. And if this starts to falter, you could well see the equity market come off quite quickly. CPI is coming through quite nicely. I've circled there the year-on-year CPI, and the latest June numbers came through at 3%. So the story is all working very nicely. It's a bit of a Goldilocks story from a US economy perspective, where the growth is still strong, the payroll numbers are still good, and inflation's coming down in a very orderly fashion. And, as a result, the good news is being priced in by the market. So that's kind of the equity view. So, a positive outlook, but some caution. I think one needs to focus on quality shares, companies that can grow irrespective of economic conditions. And that's where we hope we position ourselves from an anchor perspective. In just a few minutes on the alternative asset class, and the underlyings can be private equity, private debt, real estate, hedge funds, structured products. And these are really assets which aren't priced daily on the market, kind of fall outside of most of what we're talking about today, vanilla equities, fixed income, bonds, etc. And what we've, this has been a trend around the world. Global high net worth families have got 30 to 40 to 50% of their assets invested in these classes. And this is where you want to be if equity markets do come off. So Anchor's spent quite some time over the course of the last while creating funds which give people the opportunity to invest in this space. And, think of these as more conservative offerings, funds which, kind of trying to compound at that kind of 0.6 to 1% per month without the volatility that you find in equity markets. So from an Anchor perspective, it's typically quite difficult for private investors to get exposure to alternative investments because ticket prices are big. To get into private equity deals, you typically need to be very wealthy or be prepared to put quite a big proportion of your investable assets into these things. So Anchor's created what we think is a nice solution where you can buy into a fund which has got a diversified range of these products sitting in the mix. So it's all about a stable return. It's about giving you the ability to invest in private equity opportunities that you otherwise wouldn't be able to. And the other big issue with alternative investments has been liquidity. So a lot of private equity investments, you have to stay invested for 5 or 7 or 10 years. Whereas here we're giving people the opportunity to invest and be able to get their money out in a month. Obviously, that means that we in turn can't have too much of a fund in the illiquid opportunities. But the balanced mix is so far giving the opportunity that we're looking for. So we've got 3 funds that are now all basically a year old. We have an alternatives local fund, and there we're aiming to achieve 10 to 15% in rands with a steady compounding return. And a lot of the returns out of this asset class come from coupons. So it's not about share prices having to go up. It's investments that are delivering returns every month and coming back as a coupon and converting through into a return profile that we think is very attractive. Then offshore, we think there's really 2 pockets of investments or pockets of asset classes that you can be invested in this space. One is the alternative investment bucket with underlying companies and structured products and the like. And the other one is yielding type investments, which are investments in debt, private debt, etc., which pay out coupons every month and give you a very stable and regular return. So our Prime Global Opportunities is a collection of some of the best hedge funds and private equity opportunities that we can garner in South Africa and around the world. We've got a very nice network that's accessing some of the best private equity deals in the world. And our Global Stable Alternatives Fund is a range of interest-bearing instruments. We've put together what we think is a really super team that's managing this process. Early on last year, we hired Dion Katz, who used to run Investec Private Banking, and he's heading up our private capital business and leveraging off the rest of our investment business. Then, so the Prime Global Opportunities Fund, just to give you a quick insight, obviously I'm not going to go through in massive detail, but you can speak to your wealth manager or IFA about what's available. But a mixture of private equity opportunities, which include US fiber, some exciting data center businesses in Europe, some good performing hedge funds, and a combination of yielding notes, which typically in aggregate earn about 8% per year. So it's a nice diversified mix of assets, and we're hoping to achieve kind of 9 to 12% in dollars out of this fund. The blue line is showing you that's exactly what it's achieved in a much less volatile fashion than equities. And we'll continue to report back to people on that. The Prime Global Stable Alternatives Fund is also an offshore fund. This is much more yield focused. So you can see the range of diversified yield instruments, and offshore, depending on what space you're in, there's between 4 and 15% yields available. These assets typically don't move up or down in price, and they pay out coupons. The one exception is US government bonds, where the yield's a lot lower, but we're invested there because we expect some capital return as well. So some nice, and this again is doing what it says on the box. It's achieved about an 8% return, annualizing at about 9%, without the volatility that comes from equity markets. So that's just lifting the lid a little on the alternative asset class, where we think there's, effectively what we've done is created some funds which give people access to invest in a basket of products that they wouldn't otherwise be able to invest in individually. So that's the kind of overall picture, guys. Domestic equities, domestic fixed income, looking at that 12 to 14% return. Interesting returns out of global fixed income. Global equities a bit more cautious. And I'm now going to hand over to Liam Hector, who's going to talk to you about local equities. Over to you, Liam.
Thanks. There we go. Thanks, Pete. I think there's being an issue with my camera here. Sorry about this. I'm just I'll present without my video on. But okay, well, thanks for the introduction, Pete, and thanks for everyone taking the time to come and listen to local equities. So South African equities had a great quarter over the last quarter. We were expecting a post-election rebound. I think the base that we were coming off was fairly low going into the quarter, and that really prompted us to move to an overweight local equities allocation within our global asset allocation. And our base case going into the quarter was that the setup was just pretty asymmetrical for South African equities. So we had a couple of catalysts that we had earmarked to kickstart a recovery for South African equities after many months or quarters of underperformance. And I think in the last presentation we gave, we said it was going to be the local allocation of South African equities, the domestically focused counters, that we're going to drive a re-rating of the local index. And interestingly, the quarter kicked off with a big move from BHP Billiton to try and buy Anglo American. And I think that was at the end of the first months, at the end of April, and that really highlighted, I think, or just put a bit of a magnifying glass on South Africa in terms of the big discounts that assets associated with South Africa were trading at that stage. So that was an interesting event that probably sparked a little bit more interest from the rest of the world into South Africa to suggest that South African assets are looking really cheap in an environment where value is difficult to come by. But obviously the big catalyst that we were looking for was the overhang that the local elections were having on the local market. And the outcome of the elections, well, certainly the expectation going into the elections was that there was going to be a benign outcome. We thought that our base case and all our scenarios was that the ANC were going to achieve somewhere around 45% of the local vote, and that they were going to do a coalition with a few smaller parties, and you were going to get onto the other side of the election, and it would be a bit more of the same, but without the overhang of some extremely negative events as a result of the election. And a couple of days, or certainly the morning after the election, when the first poll came out to suggest that the ANC were hovering around 40%, so far worse than certainly our base case, and I think a lot of the consensus around the market was expecting. There were certainly some nervy moments. What really happened was it opened up the possibility that the ANC were going to have to do a deal with the less market-friendly far left. And that created a lot of nervousness. You could see it in the market. People were unsure of exactly where to place their chips, ourselves included. It was certainly not part of our scenario planning that was going to be the case. We obviously thought that there was we always have to be prepared for left tail events, and this certainly brought one to the table. Lots of discussions over those few days, but when it emerged that the ANC were taking quite a pragmatic route, and that the outcome was going to be quite a peaceful one, and the pragmatic route being the deal that they've done with the Government of National Unity, all of a sudden a scenario was put on the table that we didn't, it wasn't even an afterthought in terms of our scenario planning. So this was so what ultimately ended up happening was a far better outcome that we planned for, that, and I think that for South Africa, that South Africans could have actually hoped for. And I think every now and then just take a step back and just consider that, we're on the other side of the elections. The election was peaceful. The ruling party for the last 30 years handed over, without there being, a big political unrest or asking for recounts of votes or anything like that. So I think in the context of Africa, it's almost unprecedented that there was such a mature response from the ruling party. And really what you saw was the risk-free rate in South Africa being measured by the 10-year bonds that we've got in the country, shifting from 12.5% very quickly down to 11%. And you saw a reaction in the currencies. The rand strengthened materially from days or even in the morning before the election, and that was response one in the market. And what you saw as a result of that in equities was a repricing of those equities that use the risk-free rate, SA government bonds, as your cost, as an input into your cost of capital. And you saw a very swift and instant repricing of South African domestic assets. And that was what I would consider, and in the process we would consider fairly ordinary and fairly rational. It's a big move to go from 1.5% or 1.5% move is a big move. It's going to move our market. But then where we find ourselves now is having to reassess as to what the outcome of this election means for assets and what we do with portfolios now. And our assessment probably would have been if our base case had happened and the ANC was at 45 and you were going to get more of the same in terms of the ANC having complete control over policy and the country. I think that our inclination would probably be to have taken profits almost on the big rally that you saw in South Africa. I mean, an 11% move for the quarter relative to the rest of the world at close to 3%. That's tempting because South Africa still finds itself in with huge structural issues, and it would have been unsure of if the post-election euphoria almost would have lasted, because some of those deeper issues might have remained in place. But where we find ourselves is certainly more hopeful, more constructive on South Africa. We think that the outcome of the elections is far better than we expected, and the outlook for the South African economy today is far brighter than what was the case going into the elections. And that really resulted in our move to double down. So we're going to stay the course on South African equities. The move to lower the risk-free rate has impacted our models, and we've shifted exit multiples higher and ratings that we prepared to place on South African assets. And for now, we're going to give South Africa the benefit of the doubt. I think that before we jump the gun, we're obviously going to be, I'll address it in the next slide, but we're quite cautious in terms of our approach of just assuming that the optimism and feeling of hope at South Africa will translate into earnings growth. But the reality is South Africa's ratings are still very depressed, and even without that, there's certainly reasons to be bullish, from a bottom-up perspective in South Africa, on a lot of the companies where earnings are still off a low base for the consumer, especially our retailers. There's certainly more reasons to be bullish the consumer today than there was, call it 6 months ago. Inflation in South Africa is moderating. Interest rates, as you'll hear Nolan and his team talk about, are starting to come off towards the back end of this year. Load shedding is in the base, and by all accounts looks to be an issue that is in the rearview mirror for now. I mean, obviously everyone was thinking that there's a good chance that load shedding would rear its ugly head again post the elections, and it looks like the people in charge have got the systems under control. And then obviously the two-pot system that comes in that could release a lot of pent-up demand on the consumer side. So and this actually happened in South Africa at a time where across other emerging markets there was a lot of uncertainty. We put Mexico and Brazil in that camp where Some of those trades were quite crowded, and the outcomes of the elections created a lot of uncertainty for investors, and all of a sudden South Africa started to screen quite attractive on a relative around the world. And it certainly, I would say, screens as one of the more attractive or more interesting investment cases globally. So I think that, you know, from here, the next leg higher gets driven by earnings growth. This optimism really has to take hold and in the economy, and you need to start to see analysts taking up GDP expectations, potentially the move lower in interest rates and or inflation certainly, and currency could potentially give the Reserve Bank some more leniency. I know we're expecting, I think, one interest rate cut between now and the end of the year, but you know, this potentially opens up the possibility of more leniency from a Reserve Bank that's really, I would say, kept its foot on South Africa's neck for a long time now, and maybe it can, you know, have a bit more leeway in terms of consumer respite. So listen, it would be remiss of us not to address the elephant in the room here. In 2017, towards the back end of 2017 and 2018, when Cyril Ramaphosa became the president of the ANC, we've been through this before, and the scars from that are still fresh in our memory. I remember sitting in the investment process and going around to all the South African mid caps and working out where operating leverage sat, and if you just added 5%, you know, 10% more revenue to these businesses, what impact it would have had on the bottom line. And I think potentially the mistake we made back then was just assuming that it was all going to work out exactly according to plan. We all know that it didn't work out. I mean, I've got a stock price on here. I'm not going to mention the name of the company, but this is just one South African mid cap where you could see that optimism driving it higher, only for that to all be undone over the next 18 months as it didn't translate into earnings growth. So for now, our chosen strategy is going to be to remain invested in the high quality, dependable large caps that we've been relying on for the last pretty much entire cycle in South Africa. We, as a business, certainly upweighted and shifted our portfolios quite quickly over the last quarter, in line with our views that South Africa was due a bounce, almost a relief bounce. So we're going to maintain those positions, but we've also set up a team internally, or almost like a special project internally, where we've earmarked, you know, about 5 to 10 mid caps in South Africa, and we're going to be speaking to them, you know, religiously, probably from the back end of July into August, to, you know, get a sense of if some of this optimism around the country is going to be translated into earnings growth, because the reality is these consumer-facing mid-caps are still on very depressed ratings. Foreigners have certainly not got the confidence to enter the market just yet. I think that's going to take a bit of time. And when people get a sense that things have turned in South Africa, you know, there's a good chance that you're going to see a prolonged earnings cycle, particularly in the consumer space. And I think that's really what's going to drive the next leg higher for domestic assets. So I think the market's still in a wait and see mode now. I think the first leg has happened and been you know, driven by a re-rating. But you know, in the next month or two, you're going to start to get feedback from management teams, and we're expecting the results to June to be very tough in South Africa. From all of our channel checks and chats with management teams, trading seemed to be incredibly tough leading up to the elections, which was right up until sort of mid to late June. And then, you know, a couple of the retailers reported just after that, and the commentary is there's almost like there's certainly been a bit of relief spending in the consumer space as the election concluded peacefully. So I think we'll just wait and see this time, and for signs of the actual recovery translating into earnings. And that's just from, you know, the lessons learned from the 2017 to 2018 period. But certainly, you know, in conclusion, I think South African equities today still look very interesting. I think that there's a good chance that, you know, that the outcome of this election will result in some structural reforms, certainly better oversight in terms of governance of the country. And, you know, we're pretty constructive on South African equity still. I mean, the setup is still very attractive going into the back end of this year, certainly into the December trading season. And that's it for South African equities. And now I'm going to hand over to Nolan and his team.
Thank you very much, Liam. And hello, everybody. It is wonderful to be back this afternoon, and for you to have dialed in to join us. Always appreciated. My name is Nolan Wagner. I'm Co-Chief Investment Officer here at Anchor Capital, along with Peter Armitage. But my day-to-day job really is I'm head of fixed income. So I'm focused on everything that pays interest rates or interest income to everyone. And from that perspective, I'm going to be talking to you for the next few minutes about our income products. I'm going to outline sort of our perspectives on where to from here. Liam and Pete have spoken a lot, and they have spoken about the South African elections. They have spoken about fixed income, interest rate expectations. So I'm going to just hop through that very quickly. But looking at the domestic environment, seismic event in the last quarter, it was the election. And what you've got here is a chart that was doing the rounds. Suspect everybody has seen it. But the point is that our policies and our politics are no longer dominated by one party. That means we are having a situation where we're in a coalition government, and there are plenty of things that are wrong with a coalition government. They're unstable, people fight, they disagree with each other. Things can get stuck in limbo, policies can stagnate, etc. Yes, I agree with all of that, but we're actually still better off than I thought we would be. And we're better off than I thought we would be because this brings with it accountability. I counted something like 18 ministries where you either have a minister or a deputy minister from different parties, and that means we're going to have people being held accountable. We're going to have focus on delivery. We're going to have a cabinet that is slightly more transparent, and I expect probably more robust debate, certainly new ideas being brought to cabinet. So from that perspective, I think, you know, yes, it's going to be a sort of challenge making this all work, but we are better off. And from that perspective, you know, I reiterate what Liam was saying a few seconds ago. If you look at what happened in Brazil a couple of years ago, election, and they kind of rode the reform agenda, the reform narrative. And as that narrative took off, their financial assets really shot the lights out, and there were significant gains. I'm not saying that's going to happen in South Africa in the near term. In fact, I think it will not happen imminently. But I do think that is a plausible scenario that the reform agenda will actually take hold in South Africa. But let's look at how the market reacted to that election. So what we have here is a chart which I've shown a few times before. But basically, the bar at the bottom shows you what the yield was at any point in time on the US 10-year bond. You add to that the sort of brownish bit in the middle, which is the cost of credit insurance in South Africa. And finally, you add on to that the cost of a currency hedge from rand to dollar. Add those three things together, you've got the fundamental fair value of a South African 10-year bond. So that's where the bond should be trading. And actually, if you buy a bond, you can actually hedge out all of the risks in the bond, and what you're left with is pretty much risk-free profits. The point is that the bond yield at which the bond actually traded is this blue line up top here. So if I add up the fundamental value of the bond was trading north of the fair value. You can see how post-election bonds have rallied. There's been a super return on bonds. I think the bond fund's done 7.5% in the last quarter, which is fantastic. But the point is that there's still a gap between the fundamental value of the bond and where the bond's actually trading. And we can call that fundamental, or that gap, a combination of two things: a liquidity premium and political risk premium. Now, that political risk premium at the moment is 1% to 1.25%. It's actually very big for South Africa. And in the context of the structural changes that took place, I actually thought that would have come down more, but it didn't. So really what that's saying to me is that if this reform agenda takes place, if we do see the government managing itself somewhat sensibly going forward, there is actually more likely than not a capability for South African bonds and consequently South African financial instruments to show significant gains. There's a sort of above size, the risks are skewed towards gains at this stage. So from that perspective, we actually like South African assets because we do think that this political risk premium should come down. But let's talk about why South Africa has this risk premium. So what we've got here is a chart that I've also shown once or twice actually, but at the bottom here, you've got a blue line that sort of runs over time. And if you look at this blue line, what have we done? We've taken the growth of economic growth in South Africa, so the sort of size of our economy, if you want, and we've looked at the economy growing and indexed it so that in 2009 it hits 100%, and then the index continued growing. And what you can really say is that as of today, the economy is about 2.5 times as big as it was in 2009. We've then done the same thing with South African debt. And you can actually see the total debt stock of South Africa over time. It kind of grew a bit, but it was growing in line with the economy up to 2009. 2009, you kind of had a lot of changes that took place. Not going to delve into those. But the point is that our debt started to grow a lot faster than the economy. And as we sit here, our national debt is 6.5 times, 6.8 times as big as it was in 2009. So we've got a situation where our debt is significantly outpacing, or growth in debt is outpacing the economy. And that is unsustainable, and the government is starting to talk about it. This is the key concern for South Africa. We need to bring this under control. The government that has come in, it is very clear to me that this government actually remains focused on this problem. They remain focused, and they continue to talk about sort of balanced budgets, etc. But really the point I want to make is it is actually quite difficult when your debt has grown like this to bring it under control. And the point I'd make is to look at Kenya. And Kenya has got a very similar situation to South Africa where the debt was out of control. And they basically tried to save their way out of the problem. So we're talking about government spending less money on social services. We are talking about governments increasing taxes. And bluntly, it didn't go down well. We've had riots in Kenya 2-3 weeks ago. We've had people storming parliament. It's actually been a big, big mess. And this all stems from the fact that it is very, very difficult for a government to, increase taxes sufficiently and to pull back on spending sufficiently to address the debt problem. So where does that leave you? It leaves you with the only way out of this thing is we've got to get our economy growing again. So people talk about Eskom, and it's been a very comfortable narrative for a while to say that, well, we've had no electricity and we need to fix Eskom so we can grow. And Eskom's taken X many billion off our economy, and we've all seen those charts. Honest truth is we're about 110 days since we last saw load shedding. And that means electricity supply has been a lot more consistent in 2024. What we haven't seen, though, is the economy bounce back. We haven't seen, economic growth of 2%, 3%, etc., sort of clawing back lost growth from previous quarters. Instead, the economy continues to be mired at 0.1, 0.2% type growth. And the question is, how do we accelerate this growth from here? And the answer is twofold. Firstly, I openly acknowledge that it takes time. So if we can consistently demonstrate an ability to actually provide sufficient power for our economy, investors will start looking at it and saying, yes, it makes sense to build a factory, a plant, a call center, or whatever in South Africa. So from that perspective, there is definitely a time lag that takes place. But the other point that must be made is it's a lot more complex than just Eskom. And that's where I like the fact that we have a new makeup to the cabinet that can discuss things like the visa problem in South Africa. They can discuss things like the fact that our ports actually still rank as some of the worst in the world. They can discuss the labor markets and look at ways of making it flexible without creating a problem. I think these are the key initiatives that we need to see. And if we start to see traction on those fronts, then I think the Brazil scenario where South Africa really takes off becomes a lot more plausible. So that's what we're really looking for. But in the interim, that 1% risk premium that I was talking about and showing you in the bonds, I think that gives us some upside to bonds. So what do we think about in South African domestic fixed income? We think the SA political risk is probably overpriced. I think that the premium is too high. I think that as that premium naturally comes down, as people become more confident and in the country again, I think that there is upside in our bonds. And we therefore see a scenario where you get your running yield, which is about 11% right now. And on top of that, there are capital gains. We've modeled on a 1% capital gain for the next year. Quite plausibly, it's more. It's a very, very difficult thing to estimate looking forward. We think that South Africa sees one interest rate cut this year. It's starting to feel like September is the month, but a lot can happen between now and then. And then we see 2 or 3 more interest rate cuts next year. That means that the prime interest rate comes down by 1% in total from where it's at right now. It's not a massive interest rate cutting cycle. And it is time to think about locking in interest rates. I think you've got a lot of propensity for capital gains. We like the flexible income fund, which gives you a good balance of stability coupled with an opportunity to earn a little bit of capital gain. But looking abroad, the global environment is actually seeing a lot of changes as well. In fact, crazy changes over the last week. And I've asked one of our quantitative analysts, who's been with us for a while, no stranger to where the money will be made, Thomas Hendricks, just to join us and chat about what's going on in the US. Thomas, are you online?
How's it, Nolan?
Hi, Thomas.
Hi,
Thomas, obviously a lot changing in the US political landscape, some unthinkable events in the last week. How is the US election playing out, and how is it sort of shaping up at the moment from your perspective?
Yeah, so going into the last big event prior to this weekend was obviously the presidential debate. They brought the presidential debate quite early this time around, just given the fact that both candidates had locked, obviously with Biden being the sitting president and Trump having locked up that race so early, they could have the debate earlier. At the debate, Biden delivered a somewhat muddled discussion and was at times incoherent, and his presidency odds directly after tumbled, giving Trump a sort of boost into the sort of mid to high 50s range. And then this past weekend, there was an assassination attempt on President Trump, or ex-President Trump, I should say. His ear was hit. It's not entirely clear exactly what happened or what the motivations were. But subsequent to that, his odds have increased even further into the sort of 60 to 65 range. After the debate for Biden, the outcome was an internal discussion at the Democratic Party around whether his age was prohibitive to him becoming president, whether he was best placed to stand. Some of the contenders who sort of had their odds increase in the direct aftermath were obviously the deputy president, Kamala Harris. Her odds went up into the teens. Right now, they're at the sort of high single-digit range. A few governors, Gavin Newsom and Gretchen Whitmer, also had odds that sort of went into the mid-single-digit range. Right now, they're in the low single-digit range. And even Michelle Obama, her odds also sort of increased to the mid-single digits, and right now back to the low single digits. In terms of when we'll have a final answer from the Democratic Party on Biden as to whether he'll stand or not, that's expected to be confirmed by the 19th of August. That's the DNC Congress, Democratic National Congress.
Thank you. But unfortunately, depending on where you sit, it does appear that ex-President Trump has a very high likelihood of finding himself back in office. What does that mean for policies?
Yeah, so based on what we've seen before, and given the sort of pronouncements Trump's been making in the lead up to the election so far, I think the policy mix we can expect is going to be relatively similar to what we saw in his first presidency term, were he to win. And that's generally in sort of, we're going to cut it up into 3 pieces. That's more protectionism, fiscal stimulus, and bigger deficits for the US. What does that mean for markets? How do we view that? And I think the broad outlook would be that that's an inflationary sort of policy mix to put into practice.
So where does that then leave us if we're talking about a inflationary policy mix in terms of the outlook for bonds and interest rate cuts?
Yeah, so in the outcome for the US, I think you'd see, we've discussed the sort of outlook for rate cuts, and we'll have a discussion on that in a second. But the outlook for US bonds, I think, is slight upward pressure. So you wouldn't see the sort of strength that perhaps some market participants are expecting. For South Africa, I think it's twofold. You'd see the protectionism might put pressure on the rand somewhat, and the inflationary US policy mix would probably have passed through to our own bonds, and that would be a slight risk factor to South African government bonds.
Thank you. And in terms of interest rate cuts?
So yeah, right now we currently see Fed funds through to mid-2025. Current expectations are over 75% probability for 4+ rate cuts of 25 bips. So just to be clear, at current rates are 5 to 5.25. If you're saying 4 or more rate cuts of 25 bips, that would leave Fed funds at 4 to 4.25. An inflationary policy mix coming in at the start of 2025 would put some upward pressure on that. So you may see, instead of 4, 5, or 6 rate cuts that are being priced in at present with a high probability, it might become more of a 3 or 4 rate cuts to mid-2025 being priced in.
Thank you very much, Thomas. And I'm going to continue here and just say, to sum it all up, what are we really saying? We're saying from a global perspective, cash remains interesting, 4 or 5% yields. Considering what Peter was talking about on the global equities, it is interesting. We do think there are interest rate cuts. They're going to be small. They're going to be delayed. There's propensity for them possibly to be pushed out even further under Trump presidency. But locking in term yield of 4 to 10 years makes sense. We like the global high yield fund. It's showing a yield of about 5.25% right now, and that's locked in through to about 26 with bonds through maturing between 2026 and 2029. So from that perspective, that's where we're looking. And then finally, I always talk about the rand. So let's just talk about the South African rand very quickly. I think, Thomas did mention that there are reasons to be concerned about the rand looking forward. Certainly a Trump presidency potentially weakens the rand. But we do subscribe to the purchasing power parity model that I've explained before, which says that the rand over time will depreciate by the inflation differential between us and the US. And we chart that as the sort of stable blue, black line. And the blue bar around that says that's a reasonable band for the rand. The rand has been significantly weaker than our fair value for a while. I think it's a function of domestic politics. It's a function of a strong dollar. And the reality is that those are likely to stay. We think that positive changes in South Africa are going to take a while to take root. So from that perspective, we're not seeing a massive runaway strength in the rand. We're actually talking about a rand for the next quarter, somewhere around about 18. I think we modeled at 18.05 in our recent navigator. And thereafter, a lot depends on policies and politics. But for now, probably stable with a slight positive tendency over time. And with that, I'm going to end my presentation and hand over to Reko Neh. So Reko has been with us for about 4 years. He is a portfolio manager here at Anchor, focused on domestic and global equities. Reko is actually joining us because Chris Lemon, another seasoned industry veteran, wrote an article on the musings of an active manager, which we published yesterday, along with our sort of navigator views. And that considers, some of the factors that we look at in terms of, what's the price of an equity, what's actually the value of the equity, how do we distinguish between the two? Now, I caution that there are a lot of people who look at these things very differently. There are a lot of different portfolio managers in Anchor. So it's not necessarily a single consistent view, but it gives you a good insight to some of the factors that come to our mind when we look at equities. Reko, over to you, sir.
Good afternoon, everyone. My name is Reko Neh. I'm part of the portfolio management team at Anchor. And this afternoon, I'm excited to be in conversation with Chris Lemon. Chris has worked in financial services since 2002, with a specific focus on private client portfolio management since 2006. Chris joined Anchor in November 2022 specifically as a portfolio manager with a focus on running segregated equity portfolios both locally and offshore. Welcome, Chris. As Nolan mentioned, you wrote an article in the Navigator, Anchor's recent strategy and asset allocation report. It was titled "The Musings of an Active Manager." You kick off the article by talking about the debate between active versus passive. That debate continues to rage on. You speak about how that debate is fundamentally linked to the question of market efficiency. So let's kick off there, Chris. What is market efficiency? Why is this question of whether or not the market is efficient important to this debate?
Great, thanks, Reko. It's good to be here this afternoon to chat to everybody. I just think it's an interesting first take. If you think of the debate around active versus passive that has kind of been steamrolling for a number of years already, it always comes from a specific angle. Can active outperform? Is passive the right solution? And each side of that debate is driven by parties with vested interests. So obviously, ETF issues are massive proponents of passive, and active managers clearly think they've got the process that unlocks the secrets of the market. But I think actually, if you roll back one step from that and you look at the first principles, I think it becomes a little bit more interesting. And that's the issue of market efficiency. Elon Musk has come into, quite a lot of, we're taking quite a lot of a lot of influence recently in this idea of first principles, saying, how do we remanufacture a car? And the first principle idea is just to say, rather than basing your view on someone else's assumptions, get to the first principles. And so before you can talk about active versus passive, let's talk about what an efficient market really means. And so how does that distinguish from active versus passive, and if the market's efficient or not? And also, is there a distinction between short and medium-term efficiency? So even if you're an active manager who thinks the market is inefficient, it doesn't help you if the market doesn't become efficient at some point, because how does it unlock the value you've seen that nobody else has? And then I think there's another side to it as well, and we'll get onto it a little bit later, I think. But there's a question that says, what do you have to believe in order to believe that the market itself is efficient? And in its simplest form, it means that every security on every exchange around the world at the end of every day is the accurate reflection of all public and non-public information. And I think if you really play that out, it's probably harder to believe that the market's efficient than inefficient if you play that to its end.
Right, Chris. So market efficiency, and it's a pretty important concept for investors to have to grapple with, as you've highlighted. And it's hard to, as you say, believe that the market is indeed efficient, especially in the short term. Let's maybe dig into that. Why is the market inefficient? One of the things that you mentioned in your article, you speak of a paper by George Soros. Famously, that's the man who broke the Bank of England, and his concepts around fallibility and reflexivity. Those are fairly high-sounding words, Chris. Could you maybe explain those two ideas to us?
Yeah, I think the paper that Soros wrote is fairly recent. It's 10 years old. I mean, all of us who've been in the markets for a period of time are looking for ways to understand the volatility that we can see on a daily basis. So our lived experience is that often prices move much more materially than changes in earnings expectations. And why is that? And an efficient market would say that shouldn't be the case. And so, throughout our career, we look for theories, processes, philosophies that help to reinforce that or help us to understand that. And the best I've seen, which corresponds with my own experience of having invested in the market for some years, is this paper by Soros. And just to bear in mind, he's got an outstanding track record, of alpha generation over time, kind of 20 years in his quantum fund of 30+ returns. He speaks about two things. He speaks about fallibility and reflexivity. They actually go hand in glove. But the principle of fallibility, I think, is very easy for us all to understand. It's just simply the fact that people make mistakes. At an individual kind of idea level, at a factual point level, we're quite good at understanding right from wrong. But as we roll up a whole variety of individual facts into creating investment cases, philosophies, asset allocation, portfolio construction, thematic overlays, you start to compound these small little errors in market participants. And that's where you get an incremental increase in this principle of fallibility, which I think makes sense, probably something we can all identify with, the idea of when we were children and you had this idea of a broken telephone. You put 10 children in a line and you start with a pretty simple sentence. And by the time it's digested, interpreted, and passed on to the next person, the sentence that comes out 10 people later is quite different from what it originally started with. And so I think that's quite easy to understand. Then this principle of reflexivity, I think, is where his theories really start to take hold. And it's quite simply the idea that says market participants' expectations of what prices will do can shape prices for a period of time. And so simply if buyers think prices should be higher and enough buyers arrive and there aren't enough sellers, prices will go higher. And as prices go higher, the original expectation of prices should be going higher is reinforced by the idea that prices are higher. And so you end up in this circular reflexive kind of process, which can get a lot of momentum. And what you're looking for actually is situations where there's a lot of momentum behind these types of reflexive systems, which can happen in markets, stocks, sectors, at different times and in different parts of the world. And so actually this reflexive system spools up momentum, which can either work in your favor or against you. And it's trying to understand the difference between the spooling and reality. Perhaps two simple examples, which we speak about in the paper, is a rare colored game. About 10 years ago, it was all the rage. not in listed markets, of course, but I Googled to see what a Black Impala Ram would cost 7 years ago or so, and it was about 700,000 Rand. And again, on another Google, if you say, I want to hunt a Black Impala Ram, you might pay 1,500 Rand for that now. And so the question is, like, how dislocated did pricing become and why? Because at the end of the day, you're still dealing with the Black Ram. Still got 4 legs. It's still an Impala, but its value has swung wildly. Perhaps something a little bit more relevant for participants in terms of markets right now is something like Bitcoin. So who knows what the fair value of Bitcoin should be? Is it potentially the ultimate store of value? Is it the perfect protection against the collapse of the dollar when the world splits from east to west? Is it a great way if you're a drug dealer to launder money? There's so many different values on it. But as prices move, people trade on that news and on those price moves. And I just eyeballed Bitcoin over the last 3 years. And if you had been invested, this is kind of your journey. Plus 70%, minus 20%, plus 65%, minus 48%, plus 65%, minus 30%, plus 300, minus 25. And so, I think just anecdotally, that's an interesting illustration of inefficiencies as we see things.
Okay, Chris. So essentially, if I could understand this for myself, fallibility means that, just talks to us as humans and how we're prone to make errors in judgment and decision making. And then reflexivity is almost about perceptions and how perceptions are not only reflected in the market, but in fact, they influence the market. So almost like that reinforcing trend that you're speaking of. Maybe let's bring this closer to home within equities. Could you give us an example of fallibility and reflexivity in action within the equity market?
Yeah, I think probably just another 3 short examples, and we'll go from quite high level to granular. So if you look at something like market technicals, so there's a whole variety of different ways to invest. Some is fundamental investing, and that revolves momentum and valuations and growth and what have you. And then you've got market technicals, which is a principle which just says, can previous stock price moves help us understand what future prices might look like? I find it interesting, with market technicals, that no matter what yesterday's price was or the shape of the price of the last 3 months, it's got nothing to do with how many oranges ShopRite might sell next month. But enough people follow it. And the interesting dynamic is actually that market technicals is followed by millions and millions of investors all around the world. And they're quite firmly established patterns around market technicals, which deliver quite clearly defined return profiles if certain patterns play out. And what I find interesting is that if enough people follow those patterns and those trading rules at enough scale, they can actually bring the outcomes that they're expecting just by the weight of how they buy and sell. And I think that's a great example of a disconnect between fair value and price, and how market participants' expectations at enough scale can shape an outcome for a period of time. A few other kind of simple examples, I think, if you look at something like Hertz, a globally listed car company, one of the major rental companies in the world. If you go back and look in October 2021, they made the announcement that they were going to buy 100,000 Teslas from Elon Musk. And the market was very impressed with that. They had some good results leading up to that as well. But on this news, a significantly large car company moved another 30% in 3 or 4 weeks, just on the back of, this is something new. They're market leading. It's going to be amazing. Electric vehicles is the way to go. It's green and we want to be involved. But there wasn't enough weighing of actually, what does this mean? Is it going to develop enough enough demand? Do consumers really want that? What is the return profile from owning another 100,000 Teslas in the company's P&L? And where do we find ourselves now? You would have seen most recently, the CEO has just lost his job. He's taken a $245 million impairment in the income statement. They've had to sell a third of their electronic or the EV vehicle fleet because there isn't enough demand for it. And so you find yourself in a situation now where something like Hertz is actually 85% lower than it was even before the bump on the Tesla news. And again, it's, the market is moving on news, not necessarily actionable information. I mean, even it's been spoken a few times. Pete spoke about NVIDIA and large tech. You could even make the case right now as, are we involved in a reflexive system right now around AI and its impact on big tech earnings? It's the only place to play. We've got very narrow market leadership. And if you're buying these shares at this kind of price right now, and your defense mechanism is, well, AI is going to change the world, and so we have to own them, I don't think you're actually dealing with first principles even. I think we all believe that AI will change the world, and we're not quite sure how. And where it becomes more difficult is in the reasonably short space of time on the reasonable short term, how is this going to influence earnings? Because we can see a huge amount of investment taking place. It's all sitting on big tech hyperscaler balance sheets. But because price is ratcheting so fast, there's a lot that has to be done from an earnings perspective before you can justify where you are. And I think that's probably another example of a reflexive system. How high will it go before the market weighs price relative to earnings? And how fast can earnings move to catch up? And I think that's part of where we are right now.
Yeah, Chris, that makes sense. Ultimately, I think what you're highlighting to me so far is just the powerful force within markets of investor behavior. Markets are shaped ultimately in what you're saying, that markets are shaped by imperfect perceptions, that those imperfect perceptions then lead to actions, and that those actions will lead to unpredictable outcomes, which to me speaks of an inefficient market in itself. Let's bring this closer to home, Chris, as we wrap up. So you're an outspoken active manager. How do you apply these concepts of market inefficiency, of fallibility, of reflexivity within your thinking as an investment manager? And finally, how do these ideas then influence your decision-making process, and how do they help you generate returns for your clients?
Yeah, thanks, Rick. I think it's an interesting one. So, I mean, it's pretty clear. I think the market's inefficient in the short term and reasonably efficient in the long term. If you roll back to some of the examples I gave you before, like rare colored wildlife or Bitcoin, where people are actually battling with the fundamentals of what Bitcoin should be and how it should operate and what its value are, you might say, oh, those are weak examples, or Hertz, it's just moved on a bit of news flow. But you'll be surprised to see how much this actually happens, even in the biggest companies we know. And an example I reference in the article again is one of the one of the big tech companies, one of the biggest in the world, really. Billions of users, covered by hundreds of analysts around the world, consensus data compiled by the top guys that you can ever imagine. Essentially, their only job is to value this company. And in the space of 3 years, the fair value on this business has gone from 400 to 100 back to 500. So you're talking about 70% downside, roughly, and then 400% upside on the same business with the same number of daily users. If you plot simple things like price to sales, sales per share, they actually went up over the period. If you look at their daily average users, they were static, and yet the market was willing to swing fair value significantly in that. And in that lies the opportunity, I think. I think as we think about how does this play out in terms of portfolio construction, the key is to understand actually that we all make mistakes. I think what's interesting, though, is that you can't believe that because we all make mistakes, that the collective result of all of our mistakes is a market price that's efficient. My view is that the market price on any share at any given point is nothing more than the clearing price for that day, but not necessarily an accurate reflection of fair value. And so what's interesting about us all making mistakes is that we don't all make the same mistakes at the same time, and that's where you have opportunities to do something. I think also from a philosophy and process perspective, just philosophically, it seems to me, we all weigh how effective what we believe is and how that plays out in the markets as it stands, and are changing market conditions reinforcing or eroding our potential advantage. And I just think, the more connected the world is, the more players there are in the market, and the faster news translates across devices. The quicker markets are willing to move on news, which doesn't necessarily affect the underlying value of the company. And I think that's an opportunity. So we've gone from years gone by, ready, aim, fire, to just fire on news flow and hope that momentum saves us. And so our job is to weigh that, have a good handle on expected returns, understand, we've heard a lot of guys talking about asymmetric return profiles, understand what your compensation should be as an equity investor. You want a risk-free rate plus equity risk premium in first world equities, which takes you to around 9%. You have an understanding of an expected return that sits in that space over time, and then recognize too that financial models are just that. They're a complicated combination of assumptions which produce an indicative value, which is not necessarily 100% correct. Financial modeling is not the same as mathematics, where 1 + 1 is always 2. And so in that context, looking for big disconnects where reflexive systems that move things beyond their fair value gives you an opportunity to not be whipsawed. So when you're trading small changes in expected returns, it can be quite difficult. But when the market gives you big changes in pricing, there's an opportunity to start to do something. And I think that's how it plays out for us on a practical level. Thanks, Rico.
Thanks, Chris. I think what you've highlighted for me today is, you know, the importance of having a robust investment process, specifically within what we do as portfolio managers. And that's what helps us to identify and quantify those dislocations between price and fair value, as you said. As an active manager, it's about having a solid strategy that allows us to capitalize on those actionable inefficiencies that we've been speaking about. And ultimately, that's what generates alpha for our clients over time. Thank you for sharing those valuable insights, Chris. That marks the end of our discussion. Thanks, everyone, for listening. I'll hand over back to Peter Armitage to wrap us up for the day.
Hi, guys. Welcome back. We're going to have a little bit of a Q&A session. Try and keep it to 10 or 15 minutes. I see Liam's cruising around the world there, backwards and forwards in his chair. So please, if you've got some questions, chuck them in the Q&A basket at the bottom. I'm going to pose a few questions coming through to a few of the people. Obviously, in terms of what's on our TV screens at the moment, it's a lot of it is Trump and Biden and the like. Nolan, maybe if you can start off, and then anybody else who wants to contribute. A Biden campaign withdrawal, the impact on US markets. So we have had some discussion in the session about the impact of Trump being in power. But, you know, what should we be doing as the US politics goes backwards and forwards, and increasingly it looks like Biden's chances are coming off. I think Thomas talked through it. But, you know, do we take some defense somewhere? How should we be viewing it? Nolan, do you want to add to that and maybe ask Chris to comment on it afterwards?
Yeah, certainly, and I think Thomas can also weigh in there. I think a Biden administration, a sort of repeat of Biden, probably won't be anyone's base case right now, but it's not impossible. We've seen things change quite quickly. Biden's policies are also probably considered stimulatory. I think he's also actually slightly protectionist, and he's kind of been forced into that by the political environment in the US, if you want. So from that perspective, I think Trump is probably more inflationary, more protective than he is, but either one will kind of see you move in that direction. So it's maybe not as binary an outcome as it could have been. From that perspective, if Biden were to drop out, the reality is a lot of the questions about him probably disappear, and it's not impossible that other people have a better opportunity and better probability of sort of dethroning Trump than Biden has. So, it's very, very difficult to call the market reaction to that. I think the market reaction towards an increased probability of a Democrat coming in, probably slightly positive, but marginally so. And would I position for it? Not enough that I'd position for it overall. I think that's a sort of August, September problem, and a lot water to flow under the bridge before we get there.
Chris, your kind of comment or feeling on the relevance of US markets, US elections on the markets?
Yeah, I think it's a difficult one, Pete. I think at the moment there are a number of other factors which I think erode that, and the market's pricing has been quite short-term. So the idea, I think, probably the bigger issue is actually just around where we are with interest rates and inflation. I think regardless of whether Trump or Biden make their way through at the end of the year, that's obviously we have consequences in the medium term, but I think the market's much more short-term in nature at the moment. So I think what's on my mind at the moment is probably this idea of US exceptionalism. So I think if you closed your eyes and bought America for the last 10 years, you've done very well. Do you still have the same opportunity to do that? At current valuations with the expectations built in is probably the bigger question. And so, I think for us, we've always had the view that, macroeconomics is important to us for equity valuations, but we back the companies to make money, come hell or high water, as long as we pay the right price for them. And so we're paying attention. I think the point that Thomas mentioned earlier on, which might rattle me to some degree, is just the shallowness of a potential rate cut cycle in the US on inflationary Trump politics, and I think that could take the steam out of some expectations, but I think we're still quite a while away from that really translating into meaningful moves.
Right, and then the anchor call in favoured asset class over the course of the last 6 months now has been SA equities, which has felt quite unusual. in an economy that's been growing at a slow pace. Liam helps us run the equity process and runs our hedge funds. Liam, what are the key calls in the SA market, and just a quick substantiation of the reasons why?
Yeah, so listen, I would say at the end of the first quarter, it was probably an uncomfortable one to present on South African equities, considering what was going on globally in the bull market that you've seen. And it actually took quite a lot of convincing, not only to everyone listening in and investors, but even within our own team. You had to get buy-in from people, and there was certainly a lot of skepticism on that call. But if you go back in time to over the course of Anchor's life, I would say locally in our investment process, we've always had a bent towards owning companies with offshore earnings, high quality businesses with offshore earnings. And I mean, this is going back over a 10-year period now. I think we've tended to be underweight the basic material sector, which is a highly leveraged sector, and then at times has been quite uncomfortable as well. But over the course of the last 3 months, certainly, April, early May, we shifted our portfolios quite materially from being extremely underweight the domestic assets, South African banks and retail and insurance and industrials. I think what happened was our portfolios really shifted to a far more neutral position, and we moved a lot of capital into South African banks in particular, and high quality domestic assets. I mean, that was really the key call. So the key call was favor those businesses that we can depend on, that have through the cycle managed to produce really respectable returns and operating metrics. I mean, I think we're quite diligent in our approach when we try and have a quality bent in our portfolio. And I mean, in terms of sectors, we must have added 7-8% to local banks. We added companies like Bidvest and Clicks, Shoprite, which I think is also once again raises some eyebrows across certainly a market that's very value orientated like South Africa, and that was really a move going into the election. So we had upweighted those high quality domestic assets. I mean, another one worth mentioning is Naspers, and it's worth mentioning because even in our global and our EM mandates, we do a lot of work on China, trying to identify if there's any extreme opportunities with the price action that you've seen over the last 3 years. I mean, I think that assessment of what happened with Meta could probably also, in the fullness of time, be seen across a lot of what you're seeing in China. Although we haven't seen the recovery like you've seen in Meta, but there certainly seems to be a longer term overreaction to asset prices there. And why I'm mentioning it is that coming through a lot of our assessment is that Tencent still often comes up as one of the most attractive large cap assets to own in China, if not the most attractive large cap asset. And as a result, the opportunity was there it's probably 2-3 months ago, or almost 3 to 4 months ago, to seriously take up Naspers and Prosus. So those remain key calls for us. Certainly a continuation of a strong domestic focused part of our market is our base case. Although we probably in a period now where the market treads a bit of water until a lot of meetings are had with management teams that really reaffirm an earnings cycle that we are expecting to see. So I wouldn't expect asset prices to shoot up like they did in the second quarter, but certainly there's enough there to keep investors interested. And I mean, it's worth mentioning, foreigners have not entered our market just yet. Very low foreigner participation up until now. And there's certainly some massive funds in South Africa that probably feel a little bit uncomfortable with what's going on if they're sitting at max offshore allocation. So you potentially see a little bit of rotation at the margin of assets back into SA, and with the way liquidity has been shaped over the last 2-3 years in South Africa, which is much lower volume, I think the markets would actually struggle to absorb a lot of those flows that you could potentially see back in SA, and you could get potentially an overshoot as a result of that. So the key calls, I mean, like really trying to scratch around in the mid-cap space. I mean, we've identified a company like Famous Brands, one where going back in time, incredible operating metrics. I mean, we used to use it as a study for young analysts coming in terms of the franchise business model and the cash generation and return on capital employed and return on equity metrics. I mean, over time, before they did the deal in the UK, that was an exceptional business and a good example of a South African success story in the mid-cap space. And you know, you look at Famous Brands today, and even without the additional 5% revenue that they could potentially get from a rebound in the consumer, you know, the business stacks up as relatively cheap, and it's done a lot of cleaning up over the last 3 to 4 years, balance sheet wise, and also certainly reducing debt. But I think load shedding it's one of those businesses where load shedding has just had a huge impact on the business. Surprisingly very negative for Famous Brands. You would think everyone would rush out and grab takeaways, but they were caught off guard with load shedding as well, with not being able to open stores. So South Africa, listen, there's a lot of opportunity in the local market. I mean, the key calls are certainly for us has been to neutralize extreme underweights in domestic assets over the last quarter, and yeah, that's where we find ourselves now.
Yeah, just to stick with you, there's another question on the Q&A. Do you guys think China's is at Black Friday sale prices in terms of valuations, given the stimulus measures? Just a quick answer to that.
Oh,
China's always been it's been a difficult one for us for quite some time.
Difficult to give a quick answer, but I mean, and listen, they're clean them now, so there's going to be quite a large announcements coming out in the next week or so out of China. But what I would say is that, you know, my answer to that question 2-3 months ago would probably have been a lot more positive. But the data that you've seen with regards to missing CPI expectations, I think deflation is an incredibly toxic thing for an economy, and China's grappling with deflation and a property market overstocked and with overcapacity, and they're struggling to digest that. So the expectation is that you're going to see large policy responses, but you know, we've been waiting for a long time, and you know, I think it's becoming increasingly difficult to call. I mean, you know, you can pick up notes almost every day with conflicting information about the value on offer there, but there's certainly, you know, in the difficult times, there's certainly businesses that offer very defensive earning streams and you know, relative to other parts of the world, I would say extreme value, and that, you know, you might need a bit of time for this to play out, but there's certainly opportunities across China. It's just it's an incredibly complicated place to, you know, try and summarize a view in the short time that we do have. But you know, I think it just requires everyone to just keep a sharp eye on the, you know, on the developments there. Yeah.
So if you had $100 offshore, would you have $5 in China?
Yeah, I certainly would. You know,
I think at these valuations,
yeah, and you know what? Like, interestingly, if I had $5 offshore, I'd probably have $5 in $100 offshore. I'd probably have $5 in South Africa as well. Like, and that's the reality. You know, like, you know, we often view, like, we do view South Africa from abroad. And I can tell you that, you know, as the Mexico election came through, it was almost like oh my goodness, like there isn't just, you can't just put all your eggs in one basket in these territories. You know, there are opportunities that emerge, and I think South Africa screens pretty attractively relative to a lot of places right now.
A question for the fixed income team. Inflation link is in South Africa. There's quite a few people in the fixed incomes. There's a question on the question board. There's quite a few fixed income managers that are saying that that's an attractive place to play. Nolan, Thomas, our views there.
Yeah,
Nolan, maybe just to start, just to explain to people what an inflation linker is, or inflation linked bond.
So an inflation-linked bond is a bond that pays a far lower interest rate, say 5% in South Africa, but your interest payment and actually the value of your bond goes up by inflation every year. So they're going to look at what Stats SA said inflation was, and every month the value of that bond increases, and actually your interest payment increases by inflation as well. So you're kind of earning 5% plus inflation. If you are running a managed fund, a balanced fund, which has a CPI plus 5 target, that's Christmas. You buy an inflation-linked bond that pays CPI +5, and you sit back and actually the bond will do all your work for you. You're going to get your target return because that's the bond is highly predictable. That's what it's going to earn. And those are the managers that are supportive or positive on inflation linkers. Thing is, if you look at inflation linkers in South Africa, you're kind of earning a lower return than you probably would on most other asset classes. So you're kind of earning CPI plus, and that makes a lot of sense if you really expect inflation is going to get out of control in South Africa. If we're going to double-digit inflation, absolutely you want inflation linkers. But in a scenario where inflation is going to bobble around sort of within the target band, the sort of 3 to 6 target band, probably hover around 5%. Nominal fixed rate bonds are paying 11%, and inflation linkers are going to yield 10 over time. So where you get to is, unless you really think inflation is getting quite high, they're just better returns around. And that's historically what inflation-linked bonds have done. And even, coming out of COVID, we saw inflation really get out of control, and, the central banks had to respond in that. You had sort of 3 to 6 months where inflation linkers gave you the best returns, and then, frankly, other assets were giving better returns. So I've never been too excited about inflation linkers. But yeah, I get where they are very useful for portfolio construction, and definitely for certain sort of mandates and objectives, they make a heck of a lot of sense.
Thanks, Nyland. Another one for the fixed income team. Maybe Thomas, you want to pick it up? How realistic is it for South Africa to get off the grey list by the end of 2025? Not sure if you look at that particularly. It's a topic that's kind of disappeared over the last while.
Yeah, I think we've had a couple of articles come out of our team on it. I think by the end of 2025 is probably optimistic. I think the broad outlook is that it's a sort of 3 to 4 year process towards getting off of the grey list. So I think that's 2025 would be a very, very positive outcome. But I think it's going to be a longer term thing than that, from my understanding.
There's a question on the board about where in the world would you invest in equities? I think if you look at the big investment banks and they'll give quarterly changes and shifts from countries and economies. I think the ones that are being favored at the moment tend to be kind of Europe and Japan. Earnings are being upgraded from fairly low levels, and valuations are quite a bit lower than what you sit within the US. We've tended to have quite a US-centric approach, and I think that's been right for the last decade. You must remember that the actual markets are not necessarily the companies that you invested in. So, all the European tech business, you kind of have to buy in America. There's very, very few that have invested themselves in the US. So a lot of global businesses are invested in the US. And that's why the US is, depending on how you measure it, 55 to 60% of global equities, but less than 25% of global GDP. It's off, where the powerhouses sit. So, we would tend to remain US dominated. Europe's looking interesting, although Europe tends to be more kind of manufacturing, oil. UK is biased towards banks, etc. So the growth companies in the world tend to sit in the US. I don't know if anybody wants to add to that from a Chris. How do you approach things from a geographical perspective?
Yeah, Peter, I think it's very similar to what you said. I think you've got to be careful, I think broadly speaking, about any kind of binary portfolio positioning. And I think that's the key. To swing wildly from one region to another based on your assessment of value can be tricky. I like the question earlier on about China being Black Friday sales type stuff, because even that's quite an emotive word, Black Friday, you've got to take opportunity of it. So my sense of it is the same. I think there's a huge difference, as an example, in geographic location of where revenue is actually generated between Pepsi and Coke, but they're both listed in America. Like you say, Shell's driven by oil, but it's in the UK. So I think that's kind of where we see things, some expensive valuations in the US. I certainly wouldn't be betting against the US broadly. We're likely to remain US-centric, look for pockets of value where we can. There are some interesting things, even the French elections where the French market started to get priced for quite negative outcomes. You've landed a kind of more benign type of structure where Parliament might be hung, but the likelihood of making massive policy changes is quite low. So I think, you know, depending on how you look at global equities, we're quite sensitive to where global returns are generated from. The US tends to be 2/3 of that. And so we have no intentions of swinging wildly from that, but are always open to looking at other things from time to time.
Okay, so we're getting towards the end of our time that we've promised to keep to. I think in the spirits of being positive on SA, Liam, if you can answer one of the questions that's come through in terms of just the view on SA banks, with Capitec having given most of the performance. And then Reko, perhaps you can end off just with how you're feeling about the SA market and what you'd be buying at the moment. Liam, do you want to kick off?
Yeah, so I saw that question. So listen, I mean, the size of a company in the index does obviously sway an outcome. So if the bank's index is up a lot, you're going to probably get, you know, the big guys having produced the bulk of that return. So it's not a surprising thing. I mean, you're seeing it all over the markets today. Capitec, I would say, you know, in the context of MSCI South Africa is, I mean, I don't know the exact weighting, but it is a material weighting, and it's not the most liquid stock. So, you know, it's got some pretty steady, very long-term holders, a lot of offshore holders there, that wouldn't have been rushing to exit on the back of this news. In fact, if there was any foreign participation in South Africa, I would imagine that, you know, Capitec and maybe a ShopRite are you know, your old faithful go-tos for foreign investors. I mean, there's no doubt that there's extreme value on offer in something like an Absa, but you know, and potentially the differential in return year to date is not necessarily justified. But you know, Absa has put out you know, 3 earnings misses in a row, and it's probably now being punished sufficiently by the market. And I would say that it's your extreme value case, whereas Capitec and probably Nubank in Brazil are 2 examples of you know, structural growth stories in banking that don't rely on necessarily purely economic growth. They're proper market share gainer stories, and for that they get a different set of investors involved. I mean, there's no doubt that Capitec is screened expensive probably from I would say late 2015 onwards. So I think it, and I think if it keeps producing the results that it has, it will remain expensive, is my view.
Yeah, maybe
Reko,
just
you want to end off by giving us some advice on local equities?
Yeah, Pete, I think just to take the leaf there off of what Liam just said. I think definitely within a local equity portfolio that I'm constructing, definitely the SA banks, you know, you've got a blend of growth potential. You've got that sort of regulatory support within SA. And I think one of the things that Liam mentioned, which is quite pivotal for us, is you've got very attractive valuations. So yeah, definitely liking the banks. Along with the Rand hedges, if you think of the likes of Bidcorp, that's what I'd be constructing and would be within my portfolio locally.
Fantastic. Okay, thanks, guys. We had over 1,300 people registered for this event. Thank you very much for the take-up. It's been great to share some of our thoughts with you. And as always, feel free to contact your financial advisor or your portfolio manager, and we're very happy to talk to you in person. These presentations are available. There's a written document called the Navigator, which you can get off our website. Go and subscribe on our website to our newsletter if you don't routinely get it. We do send something out daily. So that document is available, and the presentations will be available over the course of the next day or 2. So thank you very much, and have a good investing month.
Awesome.